Hi. In this recording, I will present our 2019 review of finance article titled "Which Factors?" This is joint paper with Kowei Ho, Haitao Mo, and Chen Xue. In this article, we argue that many recently proposed, seemingly different factor models are in fact closely related to the Q factor model. In particular, we show that in spanning regressions, this is factor spanning tests, the Q factor model largely subsumes the Fama-French 5 and 6 factor models. The stamp and yuan factors are sensitive to their construction, and once we replicate their factors using the more traditional, more standard approach, their factors actually quite closely correlated with the Q factors, with correlations of 0.8 and 0.84. The Daniel Hirschleifer and Zhang factors are also sensitive to their factor construction. Once we replicate their factors through the more standard approach, their factors are also close to the Q factors with correlations of 0.69. Finally, we show that valuation theory predicts a positive relation between expected investment and the expected return. This prediction contradicts the argument in Fama-French 2015 in their motivation for their CMA factor, which is a different version of our investment factor. So we're pretty happy that this article won the 2019 Best Investments Paper Award from Review of Finance and the European Finance Association. So we would like to thank the editorial board members for their support. So the outline for the presentation is as follows. So I'm first going to describe the playing field consisting of the competing factor models. And then I'm going to describe the spanning tests. This is basically pairwise factor spanning tests. And finally, I'm going to discuss asset pricing implications of the accounting valuation theory. In a companion paper titled "An Augmented Q Factor Model with Expected Growth," also published at Review of Finance early this year, 2021, so we conduct more large-scale empirical horse races using 150 significant anomalies. All right, let's look at the playing field. So we consider 8 competing factor models. We offer 2. These are our Q factor model and Q5 model. As noted, the Q5 model is constructed in our companion paper, which I will have a subsequent video presentation as well. So the Fama-French 5-factor model and 6-factor model, as well as alternative 6-factor model with cash-based RMW. This is their cash-based operating profitability factor. So the 5th model, the 6th actually, is 1, 2, 3, 4, 5. The 6th model is the Stanbone Yuan 4-factor model. And the next we have Bareilles and Shanken 6-factor model. So their lineup includes the market factor, SMB. This is the Fama-French 3-factor specification of SMB. And our Q factor. Q factors, this investment and ROE factors from our Q factor model, and Asni-Frazzini monthly form HML, and as well as UMD from the Fama-French 6-factor model. And then finally, we have Daniel Hirschleifer and Zhang 3-factor model. A little bit more details. Our Q factor model includes market factor, a size factor, our investment factor, and our ROE factor. A little bit more details. So we construct our Q factors from independent triple 2x3x3 sorts on size, investment to assets, and ROE. Size is fairly standard, that's just market equity. Investment to assets, we follow Cooper, Gould & Shill 2008 paper and measure investment to assets as total asset growth. And finally, ROE is income before extraordinary items scaled by 1/4 lagged book equity. So in the triple sorts, we use 50-50 break cutoff for market equity, 30-40-30 for investment to assets, and 30-40-30 for return on equity. We use value-weighted returns. So again, you can see where I follow closely Farmer French 1993 and 1996. So the timing in terms of sorting frequency, we're using annual sorts on market equity, annual sorts on investment to assets, but the monthly sorts on ROE, as explained in my prior presentation on the Q factor paper, Hoshi and Zhang 2015 at RFS. So our monthly sorts actually befit our economic modeling because we are using current ROE as a proxy for expected ROE, whereas in the economic model, it is our expected profitability that is correlated with the expected return. So the fact that we use monthly sorts, we use quarterly earnings, we use more up-to-date earnings data as a proxy for expected earnings, for expected profitability. So, and that's why we end up with monthly sorts. So in the internet appendix, online appendix, for this paper, we reported that the results, our overall results are robust to all monthly sorts on size, investment, and ROE. And I should point out that monthly sorts on ROE is important. If you use annual sorts on annual ROE, the results will weaken. Okay, and then because that will not be distinguishable from Farmer French's version, which is RMW, robust minus weakness on operating profitability. But the fact that our using quarterly earnings scaled by 1/4 lagged book equity, and this is quite important. First of all, it befits our economic model, and second of all, because quarterly earnings data are available right after quarterly earnings announcement dates, so there's quite a bit of informational advantage that we get to use. So in this article, this 2019 Review Finance, we extend our Q factors, especially the ROE factor, backwards in time from January 1972 to January 1968. And in our prior work, that's the Q factor paper, we started the sample only in January 1972 because we were restricted by the earnings announcement dates as well as quarterly book equity data. And to extend the Q factors backwards by 5 more years, this way we have our sample roughly more comparable with the Farmer French influential work. So to achieve the extension prior to January 1962, we use the most recent earnings from the fiscal quarter ending at least 4 months prior to the portfolio formation. Basically, whenever the quarterly earnings announcement dates data are not available in CompuStat, quarterly files, we basically impose a 4-month lag on prior earnings, quarterly earnings. And we maximize the coverage of quarterly book equity through our imputation procedure, and which I detail on this slide. We always use quarterly book equity whenever available. And the first step of our extension or imputation procedure is to supplement the coverage for fiscal quarter 4, the 4th quarter, with book equity data from CompuStat annual files. Okay, so book equity is stock variable, so we get to use annual files directly as 4th quarter book equity. And there's no time aggregation because book equity is a stock variable. The next step in our imputation is that if available, we backward impute the beginning of quarter book equity as end of backwards compute Suppose we have current book equity data, but not the prior quarter book equity data. Okay, and we can impute the prior quarter book equity data using clean surplus relation, which is end of quarter book equity minus quarterly earnings plus quarterly dividends. Okay, this is what we say. We look backward imputation. Finally, if the backward imputation is not available, okay, if we're missing the end of quarter book equity, we do forward impute. Okay, so the name is forward impute, but all this data are historical data. Okay, we ensure there's no look-ahead bias. Look-ahead bias is something that I have some unique understanding, if you know what I mean. So finally, as noted, if nothing else is available, we do forward impute quarterly book equity as, again, old prior quarter book equity, okay, and plus, so BEQ T minus J is the latest available quarterly book equity as of quarter T, and then IBQ is cumulative quarterly earnings between quarter T minus J and the quarter T, okay, and DVQ is cumulative quarterly earnings, okay. So basically, we apply the clean surplus relation cumulatively, and we always use historical data. Okay, so in my prior example, I said suppose the prior quarter, prior 1 quarter book equity data is not available, and we say, hey, what happens if the prior 3 quarters book equity item was actually available? In that case, we just do forward imputing. We start from prior 3 quarter book equity, and then we impute, we accumulate from quarter T minus 3 to T minus 1 in terms of quarterly earnings and quarterly dividends, and we apply this equation, we get to physical quarter T minus 1. All right, so in our Q5 paper, it's an augmented Q factor model with expected growth, and that just came out of early this year, came out of review of finance early this year. We augment the Q factor model with expected growth factor to form the Q5 model. Okay, and that's our expected growth factor. And then in this paper, this is still our companion paper. In the Q5 paper, we stress tests based on a large set of 150 anomalies, and we show that the Q5 model improves on the Q factor model substantially. So a little bit more detail about the construction of the expected growth factor. We forecast tau year ahead. So we forecast 1, 2, 3 year ahead, but in the factor construction, we ended up using a 1 year ahead investment to asset changes by monthly. We do the forecasting through monthly cross-sectional regressions. And we motivate our predictors based on a priori conceptual arguments. Okay, so we ended up using Tobin's Q, operating cash flow, and change in return on equity. So, and the expected growth factor, it's monthly sorted, independent 2x3 on size, and expected 1 year ahead investment to asset change. So the Pharma French 5-factor model is based on their 3-factor model with 2 additional factors. RMW is their version of profitability factor, and CMA is their version of investment factor. Okay, so their investment factor is based on our same investment to asset variable, which is in turn from Cooper, Gould, Shill paper. And their profitability factor is they're using annual sorts. They are not using ROE. ROE will be fairly weak, and they ended up using operating profitability. So in their subsequent paper, 2018 article, they subsequently added the UMD into their 5-factor model to form the latest formulation, which is a 6-factor model. So I don't think that's a whole lot of dispute about the historical timeline, and I think yeah, okay. So, but just a little bit. I don't want to emphasize this too much, but I believe the Q-factor model predates the Farmer-French 5-factor model by a number of years, and we can debate on exactly how many years. I'm okay with that. The Stenbaum-Yuan model, they start with 2 clusters of anomalies. Actually, they started with 11 anomalies. The detailed lists are given down here, and then they applied the cluster analysis, which is quite close to principal component analysis, not exactly, but the basic idea is like, let's see from their empirical correlation structure and how many clusters are there. They end up saying, okay, look, there are 2 clusters. The first cluster they call management, which includes net stock issues, composite issues, accruals, net operating assets, asset growth, change in gross PV and inventory scaled by lagged book assets, but lagged assets. The second cluster they call performance. This consists of failure probability, O-score, momentum, gross profitability, and the return on assets. So it's kind of self-evident. If you just stare at these variables, you see that the management cluster is basically investment, right? All the variables in cluster 1 are different versions of our investment variable. And the second cluster is basically different measures of profitability. Okay. So then Stenbaum-Yuan form composite scores by equal weighting of stocks percentiles in each cluster. And of course, you need to realign each variable such that, the low minus high return is positive, and that's their alignment. They then form management and performance factors from independent 2x3 sorts by interacting size with each composite score. So however, Stenbaum-Yuan deviate from traditional construction in important ways. So they use 20-60-20 breakpoints and all breakpoints, NYSE, Amex, NASDAQ, as opposed to more standard procedure from Farmer-French 93, NYSE breakpoints and 30-40-30. Okay, so by using all breakpoints and more extreme breakpoints, Stenbaum-Yuan are tapping deeper into the extreme tails of the distribution, and thereby inflating to some extent their return premiums, their factor premiums. So the second non-standard aspect of their construction is that their size factor contains stocks only in the middle portfolios of the 2-way sorts, whereas the standard way, again from Farmer-French 93, is to use across all portfolios. So we document in this paper that their non-standard construction actually exaggerates the explanatory power, inflates their factor premiums, therefore inflate their explanatory power for anomalies. Okay, so in our work, therefore, we use both the original factors as well as our replicated factors through the traditional construction. And as noted, again, they are our reproduced factors. We follow their exact procedures. We get to their numbers quite close to their numbers. So we use their original factors downloaded from Yuan's website, which are very close to our reproduced factors anyway. But we use the original factors, and we show the results are sensitive to the construction method. Daniel Hirschreifer and Zhang model. They have market, financing factor, and PEAT stands for post-earnings announcement drift. So financing factor is based on 1-year net share issues and 5-year composite issues. And the PEAT The drift, post-earnings announcement drift, is based on 4-year cumulative abnormal return around the most recent quarterly earnings announcement dates. Okay, that's so their construction also deviates from the more standard approach. So again, they use 20-60-20, although they do use NYSE breakpoints, but not the more standard 30-40-30. So again, 20-60-20, you are tapping by high minus low. You are using high 20% minus low 20%, whilst the more standard procedure is high 30% minus low 30%. So you are tapping deeper into the two extreme tails. So they use abnormal announcement daily returns only, as opposed to standardized unexpected earnings, as well as revisions in analyst forecasts. Okay, so I would argue that standardized unexpected earnings is probably the most standard measure of earnings surprise in the accounting literature and finance as well. So their sorting procedure on financing variable is quite involved. Okay, so I'm not gonna describe the details. It will take a while, but the details are reported in our paper. So what we're gonna do is that we're gonna use both reproduced and replicated. Replicated means we're using the more standard approach. Reproduced means that we're using the exact approach, and our reproduced results are very close to what they report in their paper, because their factors are not posted online at the time. When we wrote the paper, we just use our reproduced factors, and we use both sets of factors in our empirical analysis. So in terms of replicated factors, we use NYSE 30-40-30 cutoff, and we form composite score of financing from combining net share issues and composite issuance. And we form a composite score of PEAT from combining daily earnings announcement returns and the standardized unexpected earnings, as well as revisions in analyst forecast by equal weighting a stock percentile rankings. And that's what we mean by composite score. All right, let's look at the results. So in this paper, we rely mostly on spanning tests as informative and concise way to compare factor models on empirical grounds. In our companion paper, the Q5 paper, we rely on large-scale empirical horse races using 150 anomaly testing portfolios. Bareilles and Zhang can argue that for traded factors, which all the factors are in our playing ground, Bareilles and Zhang actually argue the extent to which model is able to price the factors in the other model is all that matters for comparison, for comparing factor models. They actually argue that testing assets are irrelevant. We are not exactly sure we agree with their conclusion, but we're gonna stick with factor spanning tests in this presentation. Whereas in a companion paper, we did the large-scale stress test factor models based on 150 significant anomalies. All right, let's look at the factor spanning tests. These are head-to-head factor spanning tests between our Q models and the Farmer French 5 and 6 factor models. Our size factor earns on average, the sample is from January 67 to December 2016. So size premium is on average 31 basis points per month. 2.43 is the t-value, and the Farmer French 5 factor model, 6 factor model, and the alternative version of 6 factor model, they can explain our size factor. This is not surprising because their size factor is pulling all the weight. You can see the loadings are enormous and the t-values are gigantic as well. Look at our investment factor. So on average, the premium is 41 basis points per month and t-value is 4.9. And across there are 3 specifications of Farmer French models. Our alpha is around 11, 12 basis points per month, and t-value, between 2.8 and 3.4. They are significant. So even though the CMA factor loadings are fairly big, but they are not sufficient to explain our investment factor. The reason is that our investment factor is based on a triple sort against the size and the ROE, okay? Whereas CMA is only based on a double sort against the size. Because investment and ROE tend to be positively correlated, but they forecast returns in opposite directions. And therefore, controlling for ROE enhances our investment factor premium to some extent. And that's what's captured here. That's reflected in our significant alphas in the Farmer-French factor models. Our ROE factor earns on average 55 basis points per month, and with the t-value 5.3. Again, look at alphas. Our alphas are all significant. The 5-factor model, the 5-factor alpha is 47 basis points. 6-factor alpha 30, because UMD is to some extent correlated with our ROE factor. So UMD plays a role in explaining, helping explain our factor, but still 30 basis points and is significant. So the RMWC is fairly strong as well, but even with RMWC, cash-based operating profitability factor, and still we are still looking at 23 basis points left as our alpha. So finally, our strongest factor is expected growth, 82 basis points per month as the factor premium, t-value 9.8. So the 5-factor alpha is 78 basis points, almost as large as our factor premium. The 6-factor alpha is fairly big as well. So 70, finally, RMWC helps shrink it somewhat further, but still has 61 basis points per month with t-value of 9.3. So the previous alphas, we're looking at individual factors, and then we're using Gibbons and Russell-Shanken GIS test to see the joint test. We ask, okay, so let's say the null hypothesis is that the investment factor alpha and the ROE factor alpha are jointly 0. And to what extent that hypothesis is true, right? It turns out that hypothesis can reject the 3 versions of Farmer-French models and then look at the GIS p-values, they're all 0. And this is even without expected growth factor. Once you add expected growth factor, you ask the Farmer-French models to explain our expected growth factor, and the GIS statistics just go way up and the p-values go way down. Borderline is that Farmer-French 5 and 6 factor models cannot explain the Q and Q5 factors. On the other hand, let's turn the table around and let's see how the Q and Q5 models can explain the key Farmer-French factors. So size factor, so where actually the Q5 model is actually making the size factor alpha marginally significant, t-value 2.3, but alpha is small, only 7 basis points per month. So we're not gonna worry too much about that. HML on average is 37 basis points per month. And you look at the Q and the Q5 alphas, we're looking at, very small 7 and 5 basis points and t-values below 1. UMD, this is momentum, 65 basis points per month, highly significant. And look at the Q factor alpha. Q factor alone can capture UMD. Alpha is only 12 basis points per month, t-value 0.5. And the expected growth adding further kicks, and so that the UMD alpha is now negative, although the magnitude is not that big anyway, minus 16 basis points. CMA, we have on average premium is 33 basis points, and this is basically 0. The Q factor model explains the CMA alpha to literally 0. And the expected growth adding a little bit noise, but again, the alpha is small, 4 basis points. RMW, 26 basis points as the factor premium. Again, our Q factor alpha and Q5 alpha, these are basically 0, 1 basis point in magnitude. RMWC, cache-based RMW creates more problem for us. So there are alphas in our Q and Q5 model are both significant, although the Q5 alpha is not big. So bottom line is that if you do joint tests, the GIS tests, so the 5-factor, the HML, CMA, RMW, the Q and Q5 model can explain it, no problem, jointly. You can see p-values are actually fairly large. If you add the UMD, not a whole lot of problem either, and the p-values are way above 5%. However, if you add the cache-based RMW, the Q-factor model is going to have problem. The p-value is 0, but the Q5 model passes the test. You cannot reject the Q5 model based on this null hypothesis. In other words, the Q5 model largely subsumes that even the strongest version of the Farmer-French 6-factor model with cache-based RMW. Now let's look at the factor spanning tests between our Q-factor models, Q and Q5 factors against the original Stenbaum Yuan factor. This is directly from their website, which we managed to reproduce anyway. So we do not think there's any problem in their empirical work. So ROE. So first of all, their model explains size and the investment factor, but they cannot explain our ROE factor or our expected growth factor. Okay, and joint test based on GIS F test, we can reject their model. Basically, they cannot explain ROE and expected growth. If we use their replicated Stenbaum Yuan model, this is based on more standard construction. NYC breakpoints and 30, 40, 30. So the results are similar. Okay, and they again cannot explain our ROE factor and expected growth factor. So now let's turn the table around to explain. Let's use Q models to explain the original Stenbaum Yuan model. Their average factor premiums. Again, their average premiums are somewhat inflated, but the bottom line is that the Q5 model actually does well even for their original factors. The Q5 model, you cannot reject the Q5 model using the GIS test based on their 2 key mispricing factors. The p-value is 0.28, right? So performance value, so that the Q5 alpha is 1 basis point, it's insignificant. 12 basis points for management, okay? So although we blow up the size factor to some extent, but again, the magnitude is not that big. So as a result, the GIS test cannot reject our model. So using the replicated version, the results are similar. We again cannot reject the Q5 model. So we again explain the performance factor. We explain the management factor. Now this time around, we also explain the size factor. In terms of alpha. Okay, only 9 basis points. In this case, alpha for management factor is only 2 basis points. The alpha for performance factor only 19 basis points, although negative. All right. So Daniel Hirschreifer and Zhang model, we again reproduced their numbers. So I think, and we're using our reproduced factors. So the Q models cannot explain their reproduced factors. No, the other way around. So the original Daniel Hirschreifer and Zhang model cannot explain the Q factors. All of them actually look at the size, investment, ROE, size, investment. They do explain our ROE factor, and but not our expected growth factor. In terms of GIS p-values, we reject their reproduced 3-factor model. Using replicated model, their replicated 3-factor model again cannot explain our Q factors. So and Q5 expected growth. The GIS test, you can see p-values are close to 0. And look at our individual alphas. They cannot explain size, cannot explain investment. They still explains our ROE factor, but not the expected growth factor. Okay. Now let's turn the table around and use the Q and the Q5 model to explain their reproduced factor. It turns out we cannot explain their reproduced factors, as you see that you can reject our models using the GIS test. The reason is that we cannot explain their p factor. Again, their p factor, one of the component in the p factor, in the original version, the reproduced factor, they only has APR, which is abnormal, abnormal daily earnings announcement returns for a few days surrounding the earnings announcement dates. Okay, and then that's a variable we cannot explain. We reported that evidence even in our 2015 RFS paper. That's the Q factor paper. Using replicated, we still have problem. Again, so APR is again one component of the P, though no longer the only component. So that's the reason our model cannot explain the replicated Daniel Hirschfeld-Francois model. Bareilles and Schenker model. So they can explain our size factor because they have our investment and ROE factors in their lineup. So we are not going to use their 6-factor model to explain investment and ROE factors, but their model cannot explain the expected growth factor. Okay, 60 basis points as our alpha. And for monthly formed HML, we cannot explain their monthly formed HML. However, if we reform the Q and Q5 models using monthly sorts on investment to assets, and then we can explain the monthly formed HML as well. So again, I don't want to, mention this change the procedure every step of the way, but the point is rather, look, in terms of economic mechanism, okay, HML and our investment factor are highly correlated. In our investment campaign framework, they are virtually identical, right? In the extreme case of no intangible capital, for example, just tangible investment, and the investment marginal cost of investment equals marginal Q. Okay, so that's basically, in other words, if you form monthly formed HML, if you want to test that mechanism, if you use monthly formed HML, you ought to be using monthly formed investment to asset factor as well. And that's what we did. And the evidence is consistent with our economic mechanism. All right, so correlation matrix, and this is an important table. It lends support to our basic conclusion, why we argue that the most recently proposed factor models are actually seemingly different from each other, are actually pretty closely related to the Q factor model, right? You see the Stenbaum Yuan's replicated management factor, and then it has a correlation of 0.84 with our investment factor, okay? So this is a very close version. Their performance factor has a correlation of 0.8 with our ROE factor. I understand that they have different interpretation. They call their factors mispricing factors. And we are fine with that because recently started to explore philosophy of science. And that's, I've learned that there's a problem called the underdetermination of theory by data. In other words, our current evidence is not discriminatory enough for us to disentangle the competing explanations that have been produced to explain asset pricing anomalies. One set of explanation based on behavioral finance, another set of explanations based on the investment campaign. Okay, we need to be more creative and think of in terms of global data and come up with more powerful tests and more data to try to disentangle, trying to distinguish these two sets of explanations. All right, so our investment factor has a correlation of 0.39 with Daniel Hirschhoffer and Sons financing factor. Okay, not as high as 84, but 69 is pretty high. Finally, the P factor has a correlation of 0.69 with our ROE factor. Again, not as high as 80, but 69 is also quite high. Okay. So bottom line is that based on the evidence, we conclude that all these factor models are actually quite similar. Okay, they come with different empirical procedures. Some are more standard than others. Okay, or in other words, some are more ad hoc than others. Okay, but in terms of, in our view, the basic economic mechanism, and at least seems to us, all these factor models are quite similar to each other. Okay. All right, valuation theory. We feel that, so one comparative advantage of Q factor and Q phi models is that we have economic motivation, economic foundation based on what I call the investment CAPM, all right, and which is a reformulation of net present value rule in corporate finance. And then we say, Lou, why not just call it corporate finance? Why do you call it the investment CAPM? Well, and we call it the consumption CAPM, no? Not the permanent income theory of consumption. And to the extent that the net present value rule in corporate finance is uncontroversial, it's not in debate at all. We've been teaching NPV rule to our MBA students for decades, right? So, and in terms of math, it's the same equations, right? So, and based on that dimension, so again, as noted, I've been recently exploring philosophy of science, and Philip Kitcher calls this unification account of scientific explanation. Okay, unification means that you explain anomalies in a field by some other laws of nature or principles that are well established in a different field. Okay, and that's my sense of, quote unquote, explain in my setup. In this sense, we are using a unification account of explain, because we're explaining asset pricing anomalies using the NPV rule in corporate finance, which is not controversial at all. Whereas on the other hand, the six-factor model, the Farmer-French six-factor model, Stenbaum-Yuan model, Daniel Hirschhoffer model, and Barilla and Schenken model are mostly statistical, empirical in nature. And I understand Stenbaum-Yuan used mispricing. Daniel Hirschhoffer and argue the underreaction, overreaction. And again, empirically, it's really hard to disentangle between our investment-based explanations and the over-underreaction. So on the other hand, again, if you subscribe to philosophy of science, in particular, inference to the best explanation, and I think the NPV rule is something pretty uncontroversial, and our explanation is consistent internally as well as externally with corporate finance, right? And of course, our economic modeling is consistent with different strands of the economics literature, including macroeconomics. So on that regard, inference to the best explanation, our own prejudice is that, and our explanation is made perhaps the best explanation. Again, I'm not exactly an impartial participant in this debate. So please keep that caveat in mind. So, and in their five-factor model, and Farmer-French actually proposed Modigliani-Miller valuation theory as a motivation for their five factors, CMA, RMW. But later on in their six-factor model, they subsequently added the UMD, and the UMD is hard to be directly, at least, motivated from valuation theory. So they actually wrote, Yeah, bottom line is that, look, so again, I don't want to beat the point too much, but bottom line is that NPV rule is not controversial, and we are using the same mathematical equation. We're just applying it in a vastly different fields and explain anomalies that are otherwise puzzling from the consumption cap band perspective. Okay, and the farmer French actually warn us against data mining, or you know, they call it dark age of data dredging that produces a long list of factors with little hope of sifting through them in a statistical reliable way. We completely agree, and that's why we emphasize the importance of economic theory, even in our heavy-duty empirical work. All right, so let me make this point a little bit clearer, because the valuation model has been used actually pretty often, especially in the capital markets research in the accounting literature. So Richardson and co-authors 2010 review article at the GAE, for example, they're actually using this residual income model as the organizing framework. So it's not just farmer French. Our point is broader than the 5-factor model. But nevertheless, let's take a look. And, so we're going to be using the 5-factor paper as an example. And this shows our, if it's not obvious already, so let me just make it obvious that we have a world of respect for farmer French. And that's why we, trying so hard to keep up our side of the conversation, because we view the farmer French 3-factor model, the 93, 96, especially the 96 paper, as the most influential study in our field, especially in the field we are working in, in the past quarter century. And that's how much we respect them. Right. Nevertheless, so because of their enormous influence, so we need to point out these issues. So hopefully we can have some changes. So farmer French attempt to motivate their 5-factor model from Miller-Modigliani valuation model, and in accounting, this oftentimes formulated as a residual income model. So basically, so this variable. So farmer French argue that all else equal, okay, and we do this all the time ourselves. Ceteris paribus clauses. Okay, in economic laws of nature are not exact laws of nature. Okay, and you have to do a lot of abstractions. All right. So so all these predictions should be interpreted as tendencies. So I'm quoting Daniel Hausman, a big-time philosopher of economics on the Wisconsin faculty, that I've been recently reading up his work. So, which is very, very deep, very profound, quite informative. Right. So, farmer French derived 3 predictions. All else equal, they argue that the lower market to book must mean higher discount rate. Okay. If discount rate is high, all else being equal, meaning earnings, profitability, future book equity, and current book equity are all fixed constant. Higher discount rate, of course, the whole fraction is going to go down. That means market book is going to go down. Or book to market is going to go up. And this is their motivation of HML. Then they say that all else being equal, right? High profitability must mean higher cost of capital, right? All else being equal, higher profitability, especially if I fixed market book, my discount rate has to move up. And this is the same channel mechanism that we are using for the ROE, for our ROE factor. So we actually, the farmer French and us, we are actually on the same page for a change. And then they argue that higher expected investment. So they measure expected investment as change in book equity going forward. So if this term is high because it enters the picture with the negative sign, that means the discount rate has to go down. Okay, so this is their argument. This is important. On this point that we disagree. So they argue that higher expected investment, it's gonna imply lower cost of capital, and then they're gonna say current investment is a proxy for expected investment, and therefore investment and the cost of capital are negatively correlated. And this is how they motivate their CMA. They're using the last bullet point as a motivation for CMA, and we're gonna take issue with that. All right, so later. So for now, let's look at. So we argue that we criticize their 5-factor paper by saying, look, the motivation part. Look, internal rate of return. So this is the residual income model. Okay, so I'm a big fan of accounting. I've spent quite a bit of time studying the accounting literature. In my view, they're actually doing asset pricing. They're actually doing valuation, asset pricing. We asset pricers, we're actually doing expected returning, to borrow language from Cochrane 2011. We're doing expected returning. Accountants are doing valuation. They're actually doing asset pricing. So I'm a big fan of accounting literature. I've learned enormously over the years from studying their work. But if you look at this residual income model, right? Precisely because they are not doing expected returning, something has to give for them to look at asset prices. And they oftentimes work with the internal rate of return. And this RI is constant across all future periods. Okay, internal rate of return, and that's not the one period that had expected return. And we know that's the case because for some well-known asset pricing anomalies, right, like a momentum, right? Momentum actually only lived within 12 months after portfolio formation. Afterwards, it's going to revert. So you cannot ignore, you cannot just say internal rate of return. Going forever, you're going to get something like a zero dispersion. But from French, ignore that. They assume, all right, don't worry about it. Let's just say internal rate of return is 1 month ahead expected return. And that the evidence is different. We produce some evidence, both based on Kuwait's 2012 JAE article and our Tang Wu and Zhang and 2014 Review of Finance article. So basically, we show that for value, actually, that's fine. S&P is probably fine as well, but for CMA and CMA is probably okay too. But for RMW is kind of, weaker version of UMD, a weaker version of ROE factor, right? So you see that the internal rate of return is gonna have a negative RMW premium, whereas AR stands for average returns. In the data is this is per annum. This is actually significantly positive, but the internal rate of return, you're looking at the negative profitability premium. Bottom line is that internal rates of returns are not what asset prices work with, which is one period that had expected return. Okay, and this point applies to the enormous implied cost of capital literature. Okay, my interpretation is that the enormous ICC literature doesn't seem to be forecast future returns very well. In a sense, probably not that surprising because on economic grounds, these are really internal rate of returns, right? They're not actually that tied up with one period ahead average realized returns. All right, so the second point is that, so from a French document that once CMA is included in the data, HML is actually redundant. So as in their valuation motivation, right? So the first bullet point and third bullet point are two separate points. So in other words, book to market and the investment factor ought to be two different factors in their setup. But empirically, they document, hey, their CMA and HML are so highly correlated, they are probably redundant. But we say, whoa, wait a second, this is exactly what we have been saying, right? So because in the investment model, the denominator is marginal cost of investment, which is marginal Q, okay? And under constant return to scale, average Q equals marginal Q equals average Q, and without debt financing, average Q is just market to book, or inverse of book to market, right? So in our factor model, in our empirical work on factor models, we've never used HML to begin with. We just say once we have investment factor, HML ought to be redundant. Okay, so and I'll get to the last point on this slide later. It turns out that the high correlation between CMA and HML can be consistent with valuation theory as well, because investment forecast returns through book to market or market to book, not the expected investment, as Pharma French argue, and this is coming up right here. So again, valuation theory is accounting model, is tautological. It must be true, right? Then how can we have an economic model predictions inconsistent with the valuation model? So something has to give, and the way that gives is saying, look, this is an accounting model. You are formulating it using internal rate of return, right? And you can still have clean surplus relation from accounting, or some kind of residual income relation, but you can use one period ahead recursive formulation of valuation theory, right? So so the first equation is basically definition of return. Okay, so this is one period ahead expected return. We take expectation on both sides. We have expected return equals expected next period price, given right here, next period dividends divided by current period price. So this is definition of accounting definition, tautological, of one period ahead expected return, right? And then what I'm gonna do, let's see if I remember. All right, I'm gonna divide both sides by book equity. BE stands for book equity, is right here, and okay. Right, so the last term, because I'm dividing by book equity dated T, I'm gonna multiply and divide by book equity next period, all right? And this is the formulation I would get. A little bit of algebra, I get this term. In other words, and you stare at this equation, okay? And then we know market to book in the data is more often higher than one, right? Economists would just call this adjustment costs. So accounting academics call this accounting conservatism. Regardless, market to book is higher than one, okay? So this is positive within the parentheses, and that means all else being equal, if I have a higher expected investment given by this term, and all else being equal, my expected return is gonna be high, okay? So by recursive substitution, so expected investment, not just one period ahead, but also multiple period ahead, expected investment and expected return ought to be positively correlated. And this is actually consistent with the investment model. And this is actually a positive relation between expected investment and expected return is actually our motivation for the expected growth factor that I will present in the Q5 paper. So finally, so past investment is a proxy for the expected investment, right? So Pharma French argue, after arguing for a negative relation between expected investment and expected return, they go on and say, let's say current investment is a proxy for expected investment, okay? So that's how they motivate the CMA. We're gonna argue, no. So it doesn't follow because unlike profitability, investment at the firm level is not very persistent. Profitability at the firm level is highly persistent, but not the investment rates. So, and there's actually a big lumpy investment literature of that's mostly at the planned level, establishment level. It's very lumpy, which means really no persistence at all. They're actually bumping around. Okay, so at the firm level, as additional layer of aggregation over establishments, but still at the firm level, investment is not very predictable. So, and we're following Farmer French 2006 set up by running annual cross-sectional regressions of operating profitability, future operating profitability, the last panel on current operating profitability. You see profitability is highly persistent. Okay, you see the R square, the AR1 coefficients, annual coefficients like 80, right? So R square of 54, even at the 10-year horizon is 11. In our implementation, we're using quarterly data, so the R square is going to be even higher. It's basically 0.8 raised to the square root of 4, okay, 4 quarters, and that's going to be the, roughly speaking, the AR1 coefficient in quarterly frequency. Whereas if you look at the persistence in book equity growth, is not persistent at all. The R square is 6% in year 1 and goes to 0 quickly. Okay, and if you use asset growth as a predictor for expected book equity growth, again, the evidence is quite similar. R square of 5% in year 1 quickly goes to 0. So bottom line is that CMA cannot be motivated in the Farmer French way. Okay, CMA can only be motivated from, bottom line is that CMA in the valuation setup cannot be motivated by this term. Okay, CMA can only be motivated, sorry, let me be more precise. CMA cannot be motivated by from the expected investment term. CMA can only be motivated, if you stay with the valuation equation, can only be motivated from market to book term. But again, that's right on the investment cap and insight that Tobin's Q and the investment rate are tightly linked up together because of the first principle of real investment. And you can motivate our expected growth factor through the expected investment term in this formulation as well. All right, so let me conclude. In this review of finance article titled Which Factors, and we show that many recently proposed seemingly different factor models are actually different versions, at least closely related to our Q factor model. So the vast majority of the subsequent of the new factor models are actually subsequent work following the Q factor model. So we believe that we feel that the Q factor model has emerged as a new workhorse model for the cross-section of returns in asset pricing. Thank you.